Welcome back. Today I'll be illustrating a portion of problem 427b found on page 259 of your 8th edition of Fundamental Financial Accounting Concepts text by Edmonds. I am mainly going to journalize these 10 events. These are typical merchandising events, and merchandising is one of the more complex chapters in any principles course. We're told in problem 427b, page 259, that at the beginning of 2013, Bradley Company had some beginning balances. I am not going to take full time to show postings throughout this problem. You certainly could do so for extra practice after following through what I've done here. The main account I'm going to post up to date is going to be inventory. We'll need to do so in order to do number 10 properly at the end. I'm not going to bother posting to the other accounts. We're told that during 2013, the company experienced these events. First, purchased inventory. Now, a good question to ask yourself with any merchandising transaction is, are we the buyer or are we the seller? Because it makes all the difference in the proper accounts needed. And this is a merchandising event. My students are taking a perpetual focus, and perpetual means we're constantly keeping the inventory asset account up to date as to all our cost in our goods on hand awaiting sale that is on hand awaiting sale. We're constantly keeping that inventory account updated, being perpetual, and it also means we're keeping the cost of goods sold expense account updated as to all our cost in those goods we've sold during the period. Here in number 1, we are the buyer. We're purchasing inventory. So being perpetual, we're going to increase inventory asset as we purchase more goods. We have more goods on hand awaiting sale and more cost in those goods on hand awaiting sale. We're doing so on account, on credit. So we owe our vendor more, Bivens Company. Now let me plant a little thought in your mind here, and that is to say that in real life it's useful information to constantly know from the books how much we owe each credit vendor at any moment. And so somehow in real life we keep separate accounts payable liability accounts for each credit vendor to whom we owe money. That way we'll always know at any moment how much we owe each. And this is costing us $4,400. And so this is the first part of what we're told here in number 1. Now technically we see they have told us the payment terms, 110 net 30, and that first number in this sequence, 1, is also telling us we have the opportunity here to get a 1% discount eventually if we'll pay early enough on this invoice by the second number in this sequence, the 10th day. We're focusing on a gross method, and a gross method regarding any discounts offered makes the upfront assumption that no discount offered will be taken, and that may or may not ultimately prove to be the case. And so if that's later found not to be the case, then we'll adjust the books later as the time comes. There is technically a second part of number 1, because number 1 goes on to say that the merchandise was delivered FOB shipping point. Well, there's 2 possible sets of freight terms, and every journey of freight happens under one of these 2 possible sets. Either FOB shipping point, as we see here, or FOB destination. Now the good news once you get the light bulb here is that in each case, in each set of freight terms, in the name it's telling us the moment, the place at which ownership legally transfers from having been the seller's goods to becoming the buyer's goods. It's always transferring in the direction of having been the seller's goods to becoming the buyer's goods. The only question is, does that ownership change happen on the front end of the journey, the shipping point, as we see here, or instead, does that ownership change take place at the tail end of the journey, the destination? In this case, in the name is shipping point, telling us that ownership to these goods that we're buying here transfers legally from having been the seller's goods, that's our vendor in this case, to becoming the buyer's goods, that's us in this case, at the front end, the shipping point of the journey. Now whoever legally owns them during the journey is who has to bear the freight cost of that journey. In this case, that's then us, because they're legally our goods, having become our goods as soon as they left our vendor's dock. So we're having to bear what is freight in to us in this case, and if and when we have to bear freight in, as here, freight in increases inventory. It meets the definition of product cost, which I sometimes call inventoriable cost, and that's because product cost, which is any cost of getting our goods for resale and getting them to us and ready for sale, and this meets that definition, we first make all product cost an asset, inventory, and freight in, whenever we do have to bear it, increases accordingly inventory. It is product cost. It's part of getting our goods for resale and getting them to us and ready for sale. We're told here that we paid those freight costs, so cash asset goes down. Okay. On average, about 50% of all journeys, we would not be the responsible party. So always read carefully. Sometimes we'll see a sort of trick question that if you read carefully enough, you'll come to realize we are not the responsible party at all. They just threw it in there to make sure we read carefully enough to come to realize we are not the responsible party. But in this case we were, and as buyer having to bear freight in. Bringing us up to number 2. Number 2 says we return 400 of that we purchased. When these later events happen that have some bearing on some earlier event, I recommend you refer back to the original earlier event and let that guide us in some things to now undo later. Specifically, that first part of number 1, where we increased inventory as we bought that stuff earlier and increased at that time an account payable liability owed to our vendor Bivens. All we're going to do as we're physically sending some of this stuff back today is undo this much of that earlier entry. So we owe Bivens this much less than before, and we have less goods on hand awaiting sale, less inventory. We've sent some back. But notice that even if this had merely been an allowance is similar to a return, but involves no physical return of merchandise, and what an allowance is an after-the-fact cost reduction that the buyer requests from the seller and is granted in order to get the buyer to keep some slightly imperfect merchandise. Even if this had been one of those allowances, we'd make this very same undo entry because we'd owe them less and we'd have less cost on hand in our existing inventory. Even though we weren't physically sending any back in that case, we'd still have less cost on hand, and being perpetual, anything that increases our cost in our goods on hand awaiting sale, our inventory, we increase inventory. But anything that decreases our cost in our goods on hand awaiting sale, our inventory, we decrease inventory, being perpetual. So even if this had merely been an allowance, we'd make this very same undo entry. Now let me catch up my postings to the inventory asset. So in number 1 we increased it 4,400 and 190 for that freight in, and decreasing it here today for returning some stuff. Bringing us up to number 3, where we pay the amount due on our account payable to our vendor Bivens, doing so within that 10-day cash discount period. Okay. Well, a couple of accounts you would have said, even back as early as chapter 2, affected here today are, we know we're decreasing accounts payable, and that's true. We're keeping that specific account payable liability for each vendor. And you would have said we need to decrease cash, and that's both true. There's technically another thing affected here today as well related to the discount. Accounts payable at this point no longer shows the 4,400 it originally got established at, because always check to see if something has changed it since the original event. In this case, we reduced it a moment ago in number 2 by 400 as we returned some of that stuff to them. So only 4,000 is the updated accounts payable balance. So let's reduce accounts payable by that 4,000, which will reduce it to 0, which is true. We no longer still owe them any money after today. We're still not paying even 4,000 cash to them, and the reason being the 1% discount. So if you want to save a math step on how much cash we're paying them, it's the maximum we'd owe them, 4,000, as updated to today, times 99% of that, which is less 1% or less 40, which is 39.60. So we're paying them 39.60 cash today, and at this point we're out of balance. Your author would typically show this in 2 journal entries, which is also fine. You'll get the same end result. If you squish his 2 together, you get my 1 for the $40 discount, where we need a credit here to put us in balance. Now the only question at this point is what account for that 40 discount we're taking by paying early, where we had been offered a 1% discount for doing so. Well, this is another of those things where it has some bearing on an earlier event. And any time that in these merchandising events something happens that's serving to undo some of an earlier event, refer back to the earlier original event, and that will guide us in the things to undo some of. So in this case, this relates back to the first event 1, and we increased in that purchase back in event 1 inventory. We increased in that event 1 purchase accounts payable. We're already reducing accounts payable. There's only one thing left from the original entry to now decrease, and that is inventory. So when we're the buyer taking a discount we've been offered by paying early, it reduces after the fact our cost in our goods on hand awaiting sale, our inventory. And referring back to the original event will guide us in that. Keep in mind your author would have shown number 3 probably in 2 journal entries, and that's fine. You get the same end result if you squish his 2 together as my 1. Let me post that 40 reduction to our inventory cost for that discount we just took. Number 4, we sell. So this time we're a seller. When we sell goods, being perpetual, we need both of 2 journal entries, a 4A and a 4B. I'll number them. The first of 2 being at the selling price. thinks I'm doing the formula. Let's fix that. The second of two will be at our cost, moving our cost in those we're selling out the door. The selling price, well, first of all, in these merchandising chapter 4, they'll always tell us both figures. They'll be nice enough to always tell us both figures. The higher should be the selling price. In this case, it goes on to say we sell it for $11,000. That's the selling price. The lower of the figures should be our cost, $6,000. That's the nature of merchandising, of course, generally, is we have to mark it up to a higher selling price. That's the way we go about making gross margin and eventually ultimate net income as a merchandiser. This sale is on account, so our accounts receivable asset goes up. And in real life, much like we keep separate account payable liability accounts for each vendor to whom we owe money, so also we'd like to know from the books at any moment how much each credit customer owes us. And so I've simply made up a pretend customer name here just to keep us thinking along those lines of how in real life we do somehow in the books maintain separate account receivable asset accounts for each credit customer who owes us money. And that way we'll always know how much each owes us. We've earned a revenue here as well. The revenue, when it's goods we're selling, we call sales revenue. Previously in the course, we've mainly seen service revenue that we recorded at the selling price of those services as we provided those, but now we're selling goods in Event 4. And we call that the sales revenue account, and at the selling price as always. But we also need to move our cost in these out the door. And we move those to the expense account called cost of goods sold. That, as always, being expense, we record with left side called debit entries, consistent with expenses like cost of goods sold, decreasing in substance retained earnings equity, just opting for the more specific expense temporary account. And it's the inventory asset we're removing this cost from. Now that this is not cost on hand awaiting sale anymore, it's been sold. So let me post that decrease to inventory, which I've now done. Now we achieved a gross margin on this sale, at least for now, of $5,000, that being the excess of the revenue at the selling price, $11,000, minus our product cost expense. Now that we've sold it, our cost of goods sold in those, $6,000. So that is what we call the gross margin subtotal of $5,000. And that's how much we just boosted company profit as a result of this particular sale. We think it to be $5,000 for now. That could later change. There are various things that could change it. For example, we see we've offered them a discount here. We've assumed under our gross method up front here that they will not take that discount, so we've ignored it for now. But they may go on to take it. Also, they could possibly return some of that, and or they could possibly request an allowance after the fact to entice them to keep some slightly imperfect of these goods, and we might grant such allowance. So there are various things that could happen after the fact here that could reduce that gross margin, but for now we believe it to be that $5,000. Event 5. We receive merchandise return from a customer. Says the merchandise that originally cost us $800, we had sold it to the customer for $14.50 cash. Now the interesting thing about number 5 is this cannot possibly be some of the Event 4 sale we just made a moment ago that's getting returned. The reason I know that is because the Event 4 sale we made a moment ago was on account, whereas this return in Event 5 is obviously an original cash sale. We've made no cash sales yet this period. So what must be coming back in number 5 must technically be some of a late last year sale that was a late last year cash sale. Well, that's okay, no big deal. I mainly point that out because as we're trying to undo some of the original, what in this case are 2 original journal entries from the original sale, we just need to bear in mind that the original A entry from probably late last year did not look exactly like 4A a moment ago that was a credit sale, the difference being the original A entry from the late last year original cash sale would have debited cash in place of what we saw in 4A a moment ago being accounts receivable. And so that helps us understand that as we're undoing some of both original sale entries, we're reducing cash. In other words, we're giving them a cash refund here today in 5A from the late last year original A journal entry. We can again set ourselves up for success with our A entry undoing the selling price from the original A entry, and in the B today that's undoing the original sale B entry from last year, bringing our cost that's now back in the door. This is a physical return, and unless told otherwise, if we're a seller physically getting some goods back, then we'll assume, unless told otherwise, that these are perfectly good, usable things. We're just going to return them into the warehouse, put them back on the shelf, and save them to resell to someone else in their place eventually. But for now, it's back on hand. And so undoing the original B journal entry from the last year cash sale is bringing this back into inventory, undoing some cost of goods sold expense we thought was out the door, but now is our cost back in the door. So on a physical return where we're the seller, we need to undo some of both original sale entries, the A and the B. The higher of the figures we're told here should be the selling price once again, $14.50, and our cost should be the lower $800 in this case. That's our cost back on hand awaiting sale, back in inventory, this being usable stuff. So this does technically undo $650 of gross margin this year because the return happened this year. So it's undone revenue $14.50 less the undone expense $800 is a gross margin reduction of that difference of $650. So our gross margin this period no longer the $5,000 originally thought after event 4, but now less by $650 following this return. It's very rare that we're debiting ever any revenue temporary account, but here's the rare case where some revenue is getting undone by our customer having returned some of that sale to us, or had they requested an allowance, in which case we would have done the A entry here only. And in the case of an allowance where we're the seller, there would have been no physical goods coming back to put back into inventory. It's rare that we ever credit any expense account like cost of goods sold, as we're doing here in the B entry, but this is the rare exception once again that is undoing some of an earlier event. So occasionally we do have to decrease a revenue or an expense. Very rare, but occasionally. Let me post that debit to inventory, since I'm trying to keep that posting up to date for when we get to number 10 later. Next, number 6. In that event 4 sale we made a few moments ago, We delivered those goods FOB destination. Well, remember, in the name in each set of freight terms, it's telling us the place, the moment at which ownership legally transfers from having been the seller's goods to becoming the buyer's goods. In this case, in the name tells us that place to be destination. Accordingly, these were still the seller's goods throughout the journey, all the way up until they reached their buyer's dock, the tail end, the destination. We were the seller in that event for sale. So these were still our goods legally throughout that journey, all the way to our customer's dock. So we're the responsible party here for the freight cost for that journey, since we legally owned the goods throughout that journey. Direction-wise, this is freight out, getting these from us to our customer. Whenever we have to bear transportation out, that does not meet the definition of product cost, like freight in met the definition. Product cost, remember, was all necessary costs of getting our goods for resale and getting them to us and ready for sale. But this is after the point of sale if we're having to bear transportation out. So it does not meet the definition of product or inventoriable cost. Instead, it's then period cost that we expense as incurred. And we've incurred expense here. Transportation out expense would be an appropriate name. So this is period cost when we have to bear transportation out. We expense transportation out as transportation out expense as we incur it. Now remember, on average, about half of all journeys, statistically, we should not be the responsible party at all. So always read very carefully. Bringing us up to number 7, we collect the amount due on the account receivable within the discount period. Well, this gets back to that 4A that created that account receivable, that 4A credit sale. Today we're collecting on that. So, of course, cash needs to come in. We know we're going to be decreasing accounts receivable. I'm intentionally saving a space in between here that I'll come back to. I had made up a pretend customer name for that specific account receivable, just keeping us thinking how in real life we somehow in the books are keeping separate account receivable assets for each credit customer who owes us money. Well, the account receivable, we can check and make sure nothing's changed it since then, and nothing has. It got established at $11,000 originally. Let's reduce the account receivable here, $11,000 today, accordingly. To reduce it any less than that would leave a balance showing they still owe us when in fact they do not. They are not giving us that much cash today, though. Today they are giving us cash of, let's see, less the 2% discount we had offered them. So the other 98% of this $11,000 is the cash we're getting from them today, which is 2% less than $11,000, which I think is $220 less than $11,000, which should be $10,780. So then the question becomes, what about the $220 discount that our customer here is taking? That needs to be a left side something in order to put us in balance. Well, once again, referring back to the earlier event will guide us, as these later events serve to undo some of an earlier event. Specifically, the earlier event that created the receivable we're collecting today was 4A. We've already here in 7 reduced accounts receivable from the original 4A. There's one other account left there in 4A, and that is sales revenue. And that is the appropriate account to now undo some of, being the seller, as our customer is taking this 2% discount after the fact by paying early that we had offered them reduces after the fact our sales revenue. So this does technically undo gross margin of this period further by 220. It means it's that much less selling price than we originally recorded up front. We used that gross method up front, assuming the discount would not get taken. It then went on to get taken, and that reduces, when we're the seller, our sales revenue after the fact. Your author would illustrate number 7 in 2 journal entries, and that's perfectly fine. If you squish this 2 together, you get my 1. Either way is okay, same end result. Number 8, we sell the land for $8,500. Well, that's land that, if you look back in the green box top of the page, had an historical cost $5,000. Well, we sell it for cash of $8,500. So let's bring in the cash. Let's remove the land from the books. Now, the land asset has been sitting all this time at its $5,000 historical cost. We no longer have the land, so we have to remove that, but we only want to zero it out. The problem at this point is we're out of balance, and the difference in this case is what we call a gain. Gains and losses are our last 2 types of temporary accounts, and they are basically like revenues and expenses, gains being like revenues, expenses being like losses. The only difference is that gains and losses are from events outside the scope of everyday operations, whereas revenues and expenses are related to everyday operations. Gains and losses are from events outside the realm of everyday operations. So if we sell, say, a property asset or an investment asset for more than was its carrying amount on the books immediately prior, then we came out good and achieve a gain, in this case $3,500 gain, as here. If the opposite had been true, if we had sold this for anything less than the $5,000 carrying amount prior, then we would have not come out so good. We would have called that shortfall a loss, and we would have recorded that loss with a debit, much like expenses get recorded with debits. Here, a gain, much like a revenue, gets recorded with a credit. Now, gains and losses do technically belong on the income statement, much like revenues and expenses. We just show them farther down toward the bottom, just above net income in many cases, to somewhat segregate them from the results of everyday operations, revenues minus expenses. But the gain and loss does impact net income, much like revenues and expenses do. And they are the last couple of temporary accounts. So we would now say that there are 5 events and 5 temporary accounts that change in substance retained earnings. Revenues and gains increase retained earnings. Expenses and losses decrease retained earnings. Dividends decrease retained earnings. And when we go through the closing process after the financial statements of each period, we would now close not just revenues and expenses and dividends, but also gain and loss temporary accounts, and sending them to retained earnings itself as the other side in the closing process. Number 9, we accrue interest income of $900. So someone owes us some interest. That's something good, an asset. Increasing the interest receivable asset $900, and we've earned interest revenue. We've provided the sort of different service of letting someone else use our money. Not quite sure exactly what it's on here, but we'll trust them. Perhaps it's merely some finance charges where our regular 30-day terms credit customers have used our money longer than the intended 30 days, and on which perhaps we're earning and charging finance charges accordingly. Could be as simple as that. And lastly, number 10, we take a physical count for inventory I recommend even perpetual companies do so because things do tend to get off due to human error, various shrinkages, breakages, thefts, etc., not reported to the accounting department throughout the year. And so even though, despite our best efforts to maintain a properly perpetual system, things do still sometimes get off. And by doing that year-end physical count, we're able to correct as needed to what's really out there in the way of our cost on hand truly awaiting sale. So let's see first what our unadjusted balance shows in our inventory asset. And at this point, let's see if I can put in a formula. Properly. And it looks like 16,950 is our adjusted inventory balance. But based on their count, 15,550 is really what's out there in the way of our cost. So what we're needing to do here is back into the difference, the reduction needed in order to get it to an adjusted balance of 15,550 that's truly 15,500 rather, that's truly there. And that in this case is a difference of, looks like, reduction 1450. So what our journal entry needs to do, remember we technically start always in the journal, is needs to reduce inventory. That's going to need a right side called credit entry to reduce the inventory asset. And at that point your only question would be, what's the other account affected? And in this case you can simply make the other side of any such adjusting entry needed cost of goods sold, because that's the appropriate expense account for product cost that has gotten out the door in some fashion, usually from being sold, perhaps in this case from some other way, but that's still the appropriate expense account. Even if you had needed to go the other way here, you could have still made cost of goods sold the other side. And once you post that credit, you'll see it does in fact reduce the inventory down to the true balance on hand, 15,500. I had intended to stick that there instead of here, but now I could draw a new line. So I, keep in mind, have not taken time here to show all postings, etc. But you certainly could have done so. You could have inserted all those beginning balances. You could have posted everything. And you could have then prepared the requested financial statements. The income statement basically would have shown the sales revenue less cost of goods sold, being a multi-step income statement requested, would have shown the gross margin subtotal of that sales revenue minus cost of goods sold. It would have then gone on to show the selling, general, and administrative expenses of, in this case, transportation out expense, being the one and only, I believe. And then probably toward the bottom would have gone on to show the interest revenue and the gain, and then gotten to net income. You would have then gone on to show a statement of changes in equity that would have shown that common stock started and finished at unchanged 20,000. That retained earnings started at 11,600, increased by whatever net income showed as your income statement's bottom line. I don't think we declared any dividends here, and so would have finished at whatever ending retained earnings you derived there. The balance sheet would have shown assets such as cash balance ending, accounts receivable, though those have gotten reduced to 0, so you could have skipped that. Interest receivable of 900 asset, and inventory asset 15,500 we see here. And totaling those assets would have shown any liability. In this case, I think did we not pay them off? Maybe not. Wait a minute. No, we did pay them off, so I don't think there's any accounts payable balance remaining. So in this case, I think no liabilities owed. You'd show your couple of equity balances, common stock 20,000 ending, and whatever true ending retained earnings you derived on your statement of changes in equity, and should have found you proved the equation there in the balance sheet. And lastly, a statement of cash flows that would have shown each cash flow, such as this operating outflow, this operating outflow, this operating outflow, this operating inflow, and this investing inflow from the sale of land, 8,500 cash inflow there, and subtotaled those couple of sections, combined them to a single net change in cash of the period, showing beginning cash balance 8,600, 8,600 that is, and ending cash balance, whatever that may have been. Then you were asked to journalize and post the closing entries and prepare a post-closing or after-closing trial balance. So you certainly could have done so, closed the sales revenue and interest revenue temporary accounts, closed the expense accounts like cost of goods sold and transportation out expense. I think those are all your revenue and expense accounts you'd close. The other side being to retained earnings, you'd post those closing entries, and then your post-closing trial balance should just show your remaining balances carrying forward for all your permanent accounts of all assets, and in this case probably no liabilities with the balance, and your couple of equity accounts, common stock, and retained earnings. So hopefully you found this helpful, and continue best of luck in your study of financial accounting.